Welcome to the deep dive. Today, we're jumping straight into what has to be one of the most contradictory economic pictures I've seen in a long time.
It's a real puzzle.
Yeah, our sources are showing this just bizarre cognitive dissonance. On one hand, you have official data saying the U.S. economy is surging, record growth.
But on the other, the American consumer is signaling a full-on psychological retreat, just record pessimism.
And that's the core tension we need to unpack.
Exactly. You, the listener, need to get why these two, completely opposite facts can exist at the same time. This deep dive is all about how these signals have decoupled.
We're going to try and synthesize why the headlines feel so jarring.
Right. From booming GDP to sinking consumer sentiment, and then you layer on top all this geopolitical friction, these huge industry breakthroughs. It's a lot.
So we've structured this around three key areas. First, that paradox itself. Blockbuster 4.3% Q3 GDP. How do we square that with consumer confidence just falling off a cliff?
And that leads us right into the whole data quality crisis from the government shutdown.
Then, next, we're going to pivot to the global picture, the geopolitical shock.
We have to look at the U.S. naval action against Venezuelan oil tankers. The market reaction was immediate.
And finally, we'll hit some major sectoral shifts. I mean, the breakthrough in oral weight loss drugs is genuinely a game changer for healthcare.
And we're seeing these critical strategic pivots in AI and, of course, the auto industry. Big things are happening there.
Okay, let's unpack this. Let's start with the good news, or, well, what looks like good news on the surface.
A headline number.
Exactly. The Bureau of Economic Analysis just dropped its initial estimate for Q3. And, I mean, the number is undeniably strong. Real GDP grew at an annualized rate of 4.3%.
And that's the sharpest jump we've seen in 2 years. The big acceleration from the 3.8% we saw last quarter.
So what's fascinating here is what was actually driving that number.
Right, because it wasn't just, corporate investment. It was primarily fueled by strong consumer spending, exports, and a lot of government spending.
That combination, it paints a picture of massive economic momentum, at least for that third quarter.
It does. But if you look closer at the composition, you have to ask about sustainability, don't you?
Well, yeah. If government spending is carrying so much of the load, what's happening with private enterprise?
And that's the wrinkle. It's kind of the canary in the coal mine here. While government spending was up and consumers were, still spending, we saw a noticeable drop in private investment, both residential and business investment.
So that suggests the high interest rates, the uncertainty around trade, it's finally starting to genuinely squeeze companies and the housing market.
Exactly. Even if the overall GDP figure looks great, the foundation might be showing some cracks.
So what does that mean for the Federal Reserve? Their main job right now is fighting inflation. This has to complicate things.
Oh, it complicates things massively. This strong GDP print makes their policy path so much harder.
Yeah.
And inflation is still stubbornly high.
Right. We track the Personal Consumption Expenditures Index, the PCE. Can you just remind everyone why that's the one the Fed watches?
Sure. Unlike the CPI, which measures a fixed basket of goods, the PCE tracks what people are actually buying. So as they switch away from more expensive stuff, it captures that. It's a truer measure of price pressure.
And what did the PCE tell us for Q3?
It climbed to a 2.8% annual pace. That's a big jump from 2.1% in Q2, and it's still well above the Fed's 2% target.
So you have an economy growing at 4.3% and inflation still hot at 2.8%.
Very tricky combination.
If the economy is growing that fast and inflation is this sticky, the market must have immediately just slashed any hope for rate cuts. Why would the Fed ease up now?
They wouldn't. And you're right, the markets responded instantly. The 10-year U.S. Treasury yield,
A key benchmark?
the key benchmark for borrowing costs globally, it spiked to 4.196%. That single number made Wall Street traders pull back their bets on rate cuts for 2026.
And the Fed already cut 3 times this year in 2025.
They did. And now policymakers are really divided on whether any more cuts are a good idea next year. The economy is it's running too hot.
Okay, so the output data screams prosperity. But let's shift to the psychological state of the consumer. This is where it gets bizarre. We're living in this vibe session where the hard numbers and feelings have just completely decoupled.
It is a genuine crisis of confidence. The Conference Board's index fell for the 5th straight month, dropped to 89.1 in December.
And just for context, that's getting close to the low points we've seen in other times of, extreme stress.
It is. But the index that's really concerning is the one that looks forward, what consumers are predicting for the future.
The expectations index.
Right. It tracks the short-term outlook for income for the labor market. It held at 70.7, which doesn't sound terrible, but it's been below that critical 80-point threshold for 11 months in a row.
And historically, that's a very reliable sign that a recession is on the horizon.
It is. The length of time it stays below that mark is a much more important signal than the specific number itself.
And what about right now? Are they just worried about the future, or are they feeling the pain in the present?
Oh, they're absolutely feeling it now. The Present Situation Index, that's their current view of things, it plummeted 9.5 points. Consumers' net views on business conditions actually turned negative for the first time in over a year.
Wow.
And this is crucial. Views on their family's current financial situation. They collapsed into negative territory for the first time in almost 4 years.
That is staggering. What are the specific pain points they're citing? What's driving this pessimism?
It's the classic concerns that hit you every day. High prices, stubborn inflation. Then you have geopolitical stuff like tariffs and trade and just general political instability. It's a toxic mix.
But despite that collapse in confidence, there's a fascinating nuance in what they plan to spend on. They're not stopping spending entirely. They're just trading down.
Exactly. They're being very selective. Planned spending on services is still healthy, but it's focused on what you might call cheap thrills and necessary services.
So like signing up for a new streaming service or going out to a local restaurant.
Right. Versus booking a $5,000 international trip. The cheap thrills, they're still doing.
Yeah.
But intentions for big, expensive things like vacations, they're spiraling downward.
Okay, here's where it gets really interesting. We have to ask how much of this conflicting picture, this total split between output and mood, is because of a literal hole in the government's ability to even measure the economy.
A huge amount. We are still feeling the structural shockwave from that 43-day federal government shutdown, October 1st to November 12th.
And this wasn't just some inconvenience, it created a verifiable data black hole.
It absolutely did.
So tell us specifically what data is missing and why does it matter so much?
Okay, so all current population survey operations, the CPS that they were suspended, that's the gold standard survey that gives us our unemployment numbers. The government they did not collect the data for October 2025, and you can't go back and get it later.
So if I go to the Bureau of Labor Statistics database for October, what do I see?
You see a dash, or you'll see the footnote that says something like, data unavailable due to the 2025 lapse in appropriations. It's a huge confirmed gap in the historical record.
And beyond just the missing month, the shutdown messed up the quality of the data going forward, didn't it? Particularly for that November report.
It caused statistical chaos. The CPS uses a sample rotation, so households rotate in and out of the survey.
Okay.
But because they missed October, the November sample had twice as many first-time participants as usual. And those first interviews are always longer and, frankly, harder to complete.
And the consequence of all that confusion was?
A series low for the November response rate. It hit just 64%. The average over the prior year was over 68%. And you can measure this instability in the margin of error.
So wait, let me make sure I'm following. We don't need to get bogged down in the exact math. But if the signal is weaker, what does that mean for policymakers like the Fed?
It means the margin of error is now much wider. The change needed for the unemployment rate to be statistically significant, meaning the Fed can be confident it's a real trend, not just a blip. That number has gone way up.
It's like trying to land a plane in the fog.
That's a perfect analogy. The Fed says it's data dependent, but the data they depend on is now far less trustworthy.
And this data uncertainty has lasting consequences for the historical record too, right?
It does. The CPS will try to produce an annual average for 2025 using the 11 months of data they have, but they've officially said they will not produce reliable quarterly estimates for the fourth quarter.
That is a massive admission that our real-time understanding of the economy right now is compromised.
Completely.
So while the Fed is struggling with these domestic signals, we've got to talk about the international disruption that just slammed oil and gold. Let's pivot to Venezuela.
This is a really serious geopolitical shock. The Trump administration escalated things dramatically, announcing and now actively enforcing what they call a total and complete blockade against Venezuelan oil tankers.
And this isn't just talk. We're seeing high-profile seizures in international waters.
Not at all. Our sources confirm 3 key incidents. There was the Skipper, seized earlier. More recently, the Centuries, a Panama-flagged tanker with 1.8 million barrels of crude heading for China, seized on Saturday.
Seized by the U.S. Navy.
Correct. And now the Coast Guard is in active pursuit of a third vessel, the Bella 1, which they've identified as a dark fleet vessel linked to Iran.
And the U.S. justification is combating narco-terrorism and reclaiming stolen assets. But seizing a China-bound tanker, that adds a whole new layer of diplomatic friction.
It absolutely does. China has vehemently condemned the seizure of the centuries, called it a serious violation of international law. And even though Venezuela is only, about 1% of global supply, this action injects a huge geopolitical risk premium into the market.
Because it shows a willingness to interdict trade on the high seas.
Involving a major power like China, yes.
And we saw the market react instantly, which just validates the consumer's fear about rising prices.
A very sharp reaction. Oil prices spiked immediately. WTI crude jumped 2% to over $58 a barrel. Brent went over $62. And it wasn't just energy.
No, the combination of that instability and a softer dollar sent investors running for safe haven assets.
Straight into them.
And that safe haven run is what broke records this week. Is this more about the instability, or is the dollar weakness the bigger driver here?
It's a combination, but the flight from risk is paramount right now. Gold surged to a new record high, $4,523.30 an ounce. It's up about 70% for the year.
Incredible.
And silver followed right behind it, hitting its own new record of $69.71 an ounce. I mean, when you see naval blockades and friction between major powers, money looks for the ultimate hedge.
Let's pivot from that volatility to genuine technological disruption. We want to close out looking at two major sectoral game changers in pharma and tech, starting with a huge biotech breakthrough.
This is a landmark moment. It really changes the landscape for healthcare access. The FDA just approved Novo Nordisk's Wegovy pill.
So an oral version of the drug.
A once-daily oral semaglutide. It's the first oral GLP-1 therapy approved for chronic weight management.
The injectable versions were already massive, but a pill solves a huge accessibility problem for people who are needle-averse or who face insurance hurdles.
And that's the key strategic insight. The pill achieved comparable results to the injectable 16.6% average weight loss over 64 weeks. But here's the real game changer. The price.
What are they doing?
Novo Nordisk plans to launch in the U.S. in early January 2026 at a cash pay price of just $149 a month.
That is fascinating. Why would a pharma company launch such a valuable drug at a relatively low cash price? They're not going through the usual high-cost insurance model.
It is brilliant market disruption. By setting a low cash price, they bypass the entire complex, costly insurance prior authorization mess. They're making it immediately accessible and affordable to millions who might otherwise be denied coverage.
So they're betting on volume.
Huge volume. The market saw this as a massive win for market penetration. Novo Nordisk shares jumped nearly 10% on the news.
Okay, shifting to tech. We're seeing a really significant strategic pivot from NVIDIA, the dominant player in AI infrastructure. They're basically retreating from a business line.
That's right. They're shifting focus from selling their own cloud services back to what they're famous for, selling the hardware. They're restructuring their DGX cloud team, backing away from directly competing with their biggest customers.
The cloud providers like AWS and Google.
Yeah, exactly. Competing with the partners who buy billions of dollars of your chips, it's a massive risk. This pivot lets them focus DGX Cloud on internal R&D developing open-source AI models, robotics.
So it's an intelligent retreat to fortify their core business.
Precisely. They're securing their position as the go-to supplier for computing, not trying to become another cloud provider themselves.
And finally, let's look at the shifting ground in the auto industry. Europe in particular, where the big push to EVs is hitting some serious headwinds.
The European auto market is a perfect case study of disruption meeting reality. Tesla's EU market share shrank significantly. It plummeted from 2.1% down to 1.4%. Their sales are down by a third.
And at the same time, Chinese rivals like BYD are gaining huge ground.
Their registrations have nearly tripled.
So what's fueling their success over a pure-play EV maker like Tesla?
They're benefiting from selling a profitable mix. That includes plug-in hybrids, which European consumers are increasingly choosing because of high electricity prices and, charging anxiety.
And this consumer shift happened just as the EU reversed course on policy.
A major policy reversal. They confirmed they are weakening the electric car sales targets. They're now allowing 10% of sales to have internal combustion engines even after 2035.
That's a huge policy headwind for pure EV companies. It legitimizes a longer transition period.
It totally changes the competitive landscape. It hands an immediate advantage to manufacturers like the Chinese firms that can offer that flexibility. It pushes pure EV dominance much further into the future.
So what does this all mean? We've gone from a 4.3% GDP number and a recession signaling consumer all the way to record high gold and deep structural shifts in global industries.
It means we are in a high-velocity, fractured economy. It's defined by radical contradiction. The U.S. economy is fundamentally expanding, and quickly. But the consumer is pulling back psychologically.
Feeling the strain of high prices.
Driven in part by that global instability we talked about. And that same instability is driving assets like gold and silver to these unprecedented highs. Meanwhile, you have these fundamental disruptions reshaping key sectors.
And the disturbing subtext through this whole conversation is that the economy is being managed, to some extent, in the dark.
And this raises a really important question for you to think about. Our discussion revealed a massive confirmed gap in critical labor stats for October and measurable unreliability in November's data. This all complicates the Fed's promise to be data-dependent.
So when the foundational data is missing or unreliable,
when it's missing for months, creating this wide statistical fog, how accurately can policymakers truly judge if they're tightening too much or easing too soon? What are the long-term governance risks when key economic indicators become permanently distorted by political shutdowns? That's something you'll have to keep mulling over as we head into this uniquely uncertain new year.